$11 trillion in lost commercial real estate value. Lending is going to get much worse, and Bay Area market forecast. That's what we're talking about today. I'm Vito Scarnecchia with the Abitano Group. Thanks for watching. Real quick, we're going to go through a couple different things, but let's talk about inventory. Inventory is still like an issue, right? I know you want me to go, hey, talk about this $11 trillion, but I got to hold out a little bit. I got to make it fun, right? So let's make this so that you can see it. And every week we do this just to see what San Jose is doing. Remember, we do high level, then down, and highs and lows. Yesterday, kind of halfway through it, and it died on me. So it's okay. Yeah, if you look, inventory has become quite the issue. I mean, it slowed down a little bit in the first part of January and December, which we expected, but we really haven't recovered from it. It went up a little bit and then went back down. Guys, that's dangerous. It's dangerous because affordability. It's dangerous because even though rates have come down, people are still going to panic buy. We need to have a better choice, better set of choices. Houses are still selling. We closed 71 houses last week just in San Jose. These are single family houses, not condos, townhouses, what have you. We closed over 300. I think it was 137 homes last week in Santa Clara County altogether. That's good. That means the demand is there. It doesn't matter what the rates are. We just don't have the supply. My feeling is we had twice the amount of supply. I think it needs to be about 700 to 800 units live, active, for sale in San Jose at any given time to make it a healthy equilibrium or equally balanced market, so that for the rate that we're looking at and the number of people that can afford it, these people that are buying it right now, they're the haves. They're the people that have a ton of money. They don't care about their rate. They know they can negotiate it down. They're doing it. Transactions from last year. Now, again, you're going to start seeing that this number gets lower as the year continues. But remember, this is from the firestorm that we had for the last 3 years. Since COVID, all the way up until April of 2022, it was a firestorm. People just bought. They panic bought. So that's why we're seeing prices come down a little bit. I don't think we're going to see much more of a contraction unless what we talk about, the $11 trillion market loss. I'll connect the dots here. Okay. So average list price in San Jose is 1.5. Average sales price is 1.6. Now, that doesn't mean anything because you look at the averages here and we're still down from last year considerably by 200,000, right? Median price is 1.5. List price to sales price ratio is 94.3 on the whole, right? We had a high of 128. We actually had somebody misrepresent their let's see if I can revert this real quick. Oh, thank you. Somebody actually messed up a little bit. We had 107 closes. The Century Oaks, no. Wait. Oh, somebody sold. I guess it got changed. Good for them. Somebody closed it and listed it as these are actives, I think. Hang on a second. Obviously, Vito, you need to work more in your MLS. Not like you don't work into it enough. Sold last 7 days, 74. That's the number I gave you. Yeah, 71. So we had a couple extra closes just now. This one right here, Creekview Middle Lane, listed at 2.99, went down to 2. Oh no, it didn't. It lasted 25 days. And nothing against the agent. It's just a small mistake. it sold for 2.85 million, not 28.5. So it skewed the numbers around. So when you look at the numbers here, these numbers are not exact. So please forgive me, but at least I let you know. So 128 is the high, 189% is a low off of original list price. And we had 53 out of the 71 homes sold over 100% over list price. That's impressive. That helped pop that number up. You have to actually remember that it's not 51 because it's 52. So that's 73%. So it's not that much of a difference. We have 82 pendings. That's 82 houses in San Jose went into contract over the last 7 days. So I have houses decreasing. We had 2 more than last week, and we had 22 come back on market. This is cumulative as well. And then cancellations the last 7 days is 15 because people had wish pricing. That number has gone down quite considerably. Okay, lending is going to get much tighter. Okay, now from a lender's point of view, whether you go to Bank of America, Quicken, or Hector, there's something called margin. That's the profit that the lender, not the bank, not the originator, needs to make in order for them to make their job profitable, right? Everything you do, you have to do it with profit. When we had prices go down crazy and rates went super low, margin compression happened, which meant that their margin went down, which is part and parcel the reason why that Signature Bank and Silicon Valley Bank went out, because they bought a bunch of low margin loans. Margins are going back to normal, which is almost 2% now. So on the Fed rate, whatever that is, let's call it 4%, banks now are going to charge 6%. And that's their profit. That's how they make business. That's how they make money. That's just the natural thing. Because of this, now there is going to be less competition. So now it's time to get their money back. And they're going to make it much more difficult for you to buy a loan or buy a house with a loan. And that means your credit has to be better. Your down payment has to be better. Your reserves have to be better. Your income has to be better, or you're going to pay for it because you're much more of a risk, just like you were before. However, there was so much competition before. Now it's less competition. Now it's time for them to make it back. And as we stated, the market isn't dying. Demand is not dying. So natural competition allows the banks to charge a little bit more, which is what they're going to do. So just be on the lookout and be aware that you can shop all you want. You can go to Quicken, you can go to wherever you want, and you're going to see prices go up a little bit higher. Where you make better rate is by buying points or giving points to the lender, bringing that rate down. We have ways of making the seller do that right now. Bay area, so this forecast right here, depending on where you are, like San Francisco County is going to be hurting for a while. Napa County's hurting mostly because it's just a small little county, still very country, but it's kind of modernizing. But our forecast is inventory will remain low all the way across, mostly because, and we've talked about this before, 64% of the houses that have a mortgage on it now have something less than 3.5% as an interest rate. Why would anybody walk away from that, sell their house, and then buy a house with 6%? They won't. They'll just deal with it. Or they'll be forced into becoming a landlord. So there's no reason for them to do that. And even if they have to put $1,000 a month into a house, they'd rather do that and keep that spread so that somebody pays down their mortgage a lot faster than somebody else. And then they go out and buy another house at 6% or 6.5%. Pardon me. So my thoughts are, being myopic as real estate is, the market is going to stay stable for the next year, the next 6 months to a year. What one of the tipping points is, when we talk about the tipping points being healthcare, credit cards, automotive, the other things, Another thing that I just learned about is the commercial retail market. Now, you go down and see all these other houses, all these buildings, and half of them are empty, or you can't get them repaired or fixed because the permit department, the inspectors aren't coming through, and shame on you for San Jose for doing that. But retail outlets, the mega stores, and you see it all over on YouTube and TikTok and Facebook and everywhere. You see people coming in. I saw it just the other day at Safeway. I was buying donuts for my camera people at the church. And on Easter, I saw a young girl stealing a big armful full of groceries out of the Safeway down the street from here. Theft is out of control. And they're like, screw you. What are you going to do? You're going to arrest me? Okay, see you, bye. I'll be out in a couple days, and you're not going to whatever, because there's no backlash. There's no punishment for the crime. So why not do it? So what we're seeing is Home Depot, just like what happened last year when they lost, what was it, $13 million worth of inventory. The Home Depot that right across from Oak Ridge went up in flames because somebody lit up the lumber yard as a diversion to steal some tools, right? They caught him. He probably got a slap on the hand. Home Depot, Gap is selling off. Whole Foods in downtown San Francisco is closing down. We've heard CVS is closing down. I understand that we have these measures to let these people go through. And whatever that is, it's not for me to decide. Who knows? But the problem is retail capitalists are not going to deal with it. Home Depot, Gap, Whole Foods, all these other stores, Safeway, they're not going to stand for that. And if you don't turn things around and massively punish these people that are stealing outright, CVS, they're going to close down. And then you're not going to have any retail offerings for your people, your residents, which is why San Francisco is being emptied out in droves. It used to be that there was 3% vacancy. Now it's like 30% of the retail commercial property out there is taken. So there's over 60% vacancy in San Francisco on commercial property. That's where you're losing that. Why am I mentioning this? Because that could be a tipping point. That could offset our economy here and light up a powder keg of problems, not just here, but across the country. Just like the credit card, just like the automotive industry, just like the healthcare, just like everything else. That's another tipping point that is becoming evident, and we're not dealing with it. We're just sticking our head in the water. So I hope that if you're a politician and you hear this, I'm pretty sure you're already aware with it, and you're like, well, I can't do anything because my upper people say I can't do anything about it. Well, that's too bad. You really should make a stand and say, we need to stop that. This is ridiculous. We're losing residents, we're losing revenue, we're losing tax revenue, we're losing property tax revenue, we're losing retail outlet stores. We're going to lose massive amounts of value in our housing and our real estate because of these loose measures. So enough of that. But I want to make sure that we talk about this. And if you have comments about it, please do so in the bottom in the comment section. I'd love to hear your thoughts on this. $11 trillion, that's a lot of money. I don't think we can. I think this could be one of the major tipping points for the country, for our economy. And I mean, I hope it doesn't happen. I hope we just, keep our head in the sand and nothing else happens, but who knows? Anyway. That's it for me. Today we talked about San Jose inventory. Oh, we didn't talk about real estate WTF of the week. We got to look at this. Hang on a sec. Look at that. Looks like a spider. I mean, there's a little kid there. That's cool. I just noticed that. But What? I don't. What are you going to do? All right. I'm Vito Scarnecchia. with the Abitano Group. With Abitano, not that group. It's not group. Not for now, it's not. We'll see you out there.